Good morning for my fellow friends and my lecturer. Today we will talk about the petroleum company. Our group members have Gong Mei Xiang, Wu Xin, Tesla, and Wang Lingchu. Next. Now we see the background of Petronas. Petroleum National Berhad is known as Petronas. It's a Malaysian oil and gas company. It was built in 1974 and wholly owned by the government of the Malaysia. The corporation is further with the anti-oil and gas reserve in Malaysia, and is still with the responsibility of developing and adding value to this reserve. Petronas is ranking among the global 15 largest corporation who and company interest in 35 countries. Petronas provide a subsequent source of income for the Malaysia government, accounting for more than 15% of the government revenue for 2015 to 2020. Next, I pass to Lin Chu.
You mentioned. Now I want to talk about profitability ratio. The first ratio is gross profit margin. And the higher this ratio, the more efficient is the performance of the company. In 2017, the profit increased 10%, and in 2018 to 2020, the profit also increased 70%. The decreasing revenue and cost of goods sold in 2018 affect the gross profit margin decrease of 47% to 41%. The revenue of petrol include gasoline, jet fuel, and other products. The impact of oil price uncertainty will affect the price for the oil and gas increase, and some people will not buy it. For second ratio is net profit margin. The higher this ratio, the more efficient is the performance of the company. The net profit margin measure how much net income and profit is generated as a percentage of revenue. The gross profit margin was related with net profit margin, and so in 2016 to 2020, the net profit margin is 97%, because gasoline and natural gas are dispensable in Malaysia and are needed by almost every household. So this is an important point to increase the net profit margin. The next ratio is return on capital employed. The higher the ratio, the more efficient the business is being managed. If the return is very low, the business may be better off releasing its asset and investing the process in higher interest bank account. And this is related to gross profit and net profit too. In 2016, it increased 1% because the lower capital employed will affect the ratio. In 2017 to 2019, remain unchanged at 30%. And while 2020, the ratio increased 2%. The second ratio is liquidity ratio. The first of this ratio is current ratio. The current ratio is a short-term measure of a company liquidity position. This ratio should be applied in conjunction with the asset ratio. It helps to decide whether the current asset will be able to generate sufficient cash to pay off the current liability when they fall due. The table shows that 2016 was the lower, and it also showed the current ratio and current liability was the lower one. The current assets include property, plant, and equipment, investment in joint venture, and long-term receivable. The current liability include borrowing, deferred income, and deferred tax liability. The second ratio is quick ratio. The quick ratio is also known as the asset tag ratio because by eliminating inventory from current asset, it provides the asset tag of whether the company has sufficient liquid resources to settle its liability. It also same with the current ratio. The lower ratio was 2060. Inventory reduction because it produces main product that include petrol, diesel, jet fuel, cooking gas, propane, and more. Other products may not have lot of variety as it is mainly sell petrol, diesel, and no other product. Now I will pass to commission.
Now we see the working capital effective ratio. Next. First is inventory turnover. For 2016 to 2018, inventory reduced because it produced main products that include petrol, diesel, jet fuel, and other products. Other products may not have lots of variety as it mainly sells petroleum, diesel, and no other products. For 2019, there has been turnover getting lower due to factors such as inventory increase and cost of sale also increasing. Inventory increase may demand for company product. Also demand increase. Cost of sale also increase. For 2020, there will be a shorter track. This is the year with the lower inventory in 5 years. This shows personal gas perhaps is able to generate itself by using its inventory effectively. Next. Second ratio is receivable debt. For 2016 to 2019, there is a longer time to get the payment back. This is because the company does not provide discount for customer. For example, discount so the customer pays slowly in 2016 to 2019. Another reason could also be offer more general or credit term. In 2019, it would take more than 2 months to receive the money. In 2020, receivable decreased because the sales were the most in 5 years, so the receivable there in 2020 are shorter in 5 years. Next. Third ratio is payable debt. In 2016 to 2018, there has been a shorter track. In 2016, payable was longer in 5 years. Account payable increased over a period. That means the company is buying more goods or service on credit rather than paying cash. In 2017 and 2018, account payable decreased because the company can make payment faster. In 2016 to 2020, there has been a longer trade. Account payable and cost of sale also increased during the year due to all price. Maybe the supplier did not provide a discount received to the company. Now I pass to Wishing. Next.
This is the earning per share from year 2016 to 2020. Earning per share is an important financial metric that indicates the profitability of a company. It's also often used by market participants to measure a company's profitability before buying a company share. From 87.9 cents in 2016 to 101.6 cents in 2020, there has been an upward trend, thereby reducing the number of shares outstanding. That means company increase earnings per share by simply buying back their own share, and they do not need to increase their income at all. Some companies also do this to manipulate investor into thinking the company is growing faster than it actually is.
Hello, my name is JC. Now I want to talk about financial risk ratio. We also can call it long-term financial stability. There are gearing ratio, debt ratio, interest cover, and ratio of long-term borrowing to cash generated from operation. And now we only need to talk about gearing ratio and interest cover. Gearing ratio is an attempt to quantify the degree of risk involved in holding equity share in a company. Risks both in terms of the company's ability to remain in business and in terms of expected ordinary dividends from the company. It's calculated as long-term borrowings divided by long-term borrowings plus equity. From the graph above, gearing ratio escalated from 2016 to 2019 and decreased slightly in 2020. Funds from creditors are richer than funds from company owners because creditors still have to pay back whether or not the business generate revenue. Company with too much debt could be at risk of default or bankruptcy, especially if lending rates are variable and interest rates rise suddenly. Interest cover is a measure of how many times a company can pay interest expenses out of its earnings. It is calculated as profit before interest and tax divided by financial cost. The higher the ratio, the better. The company is in a better position to pay the fixed charge of interest because their interest cover continuously decline.
In the conclusion, based on the overall performance, the Petroleum National Berhad that there is a less risk company of liquidation occurring due to inability to pay interest changes in interest rates, especially upward trends that have less impact on companies. The Petroleum National Berhad have a lower interest cover means that they have less income or earnings are available to pay more interest, and business are more vulnerable to rising interest rates. For that reason, in view of interest cover indicates above interest cover is decreased, but the Petroleum National Berhad still ability of a company to pay interest out of profits generated. Then have the suggestion to improve company's performance that there is to increase profits before interest and tax, like generating, managing costs, or more revenue better. Secondly, for instance, reducing the finance costs through and may let the Petroleum National Berhad have higher interest cover.